Hey everyone, welcome back to the Deep Dive.
Good to be here.
Today we're tackling, well, a big one. DLF Ltd, a real titan in Indian real estate.
Absolutely.
We've sifted through a whole stack of their latest stuff, detailed financials, press releases, even the chairman's speech from their recent AGM, the 60th one.
Yeah, quite a bit of material.
Our mission today is simple. Cut through it all, especially their Q1 FY26 results for the quarter ending June 30, 2025. We want to pull out the key insights for you.
Give you that shortcut.
A shortcut to understanding where this giant is heading. What do these dense documents really tell us about their finances, their strategy, and, well, the future of housing and commercial space in India?
Right. And we're not just reading out numbers. The idea is to get behind those headlines. Understand the drivers, what these figures mean for a company like DLF.
And the wider implications, too.
Precisely. We want you to walk away with a much clearer picture of their strategic game plan.
Okay, let's dive in. Unpack these Q1 FY26 results. The consolidated picture, the top-line numbers, they seem pretty striking. What were the main highlights?
Well, the big headline number is the consolidated net profit. It came in at Rs 766 crore for the quarter.
766 crore, and how does that compare?
That's a significant 19% jump year on year, so strong growth there.
19%. Okay. And revenue?
Consolidated revenue hit Rs 2,981 crore. And EBITDA, that's earnings before interest, taxes, depreciation, and amortization, was Rs 628 crore.
Right. So a 19% profit jump is solid. But looking beyond profit, what else stands out, financially?
What's really interesting, I think, is their net cash position. It actually improved further.
Oh, yeah. To what?
Got up to Rs 7,980 crore by the end of June. Nearly 8,000 crore net cash.
Wow. For a real estate company, that's a lot of cash.
It really is. It shows strong cash generation, obviously, but also really disciplined capital management, financial robustness.
Makes sense. And I guess that ties into their credit ratings.
Exactly. No surprise they've maintained strong ratings. ICRA A positive and CRISIL A positive. Those AA ratings for a company this size, that's a big signal of stability.
Lower borrowing costs, more flexibility for growth.
Precisely. It underpins their ambitious plan.
Okay, so strong profits, loads of cash. But real estate lives and dies by sales, right? How did the new business look? Bookings, collections.
This is where you really see the market momentum. New sales bookings for Q1 were, get this, Rs 11,425 crore.
11,425 crore in one quarter.
Yeah, and that represents a massive 78% year-on-year growth.
78%. Okay, that is an eye catcher.
It really is. And collections were strong, too. Rs 2,794 crore. The company generated a net cash surplus of Rs 1,131 crore just in this quarter alone.
So that's 78% growth in bookings. That tells you quite a bit about current demand, doesn't it?
Yeah.
Especially for the kind of high-quality stuff a DLF builds.
Absolutely. That number screams robust demand, particularly at the higher-end luxury segment where DLF is a major player. It reflects buyer confidence.
Okay, let's dig into that development business then. What's fueling this kind of momentum? The reports mentioned a great response to their new luxury launch, DLF Privana North.
Right, Privana North, part of their bigger Privana ecosystem.
What's the secret sauce here? How do they keep delivering these kinds of results?
Well, connecting it to the bigger picture, their strategy really leans on some core assets. They have this high-quality land bank.
Right, existing land holdings.
Exactly. In established prime locations, Gurugram, Delhi especially, this lets them grow without constantly needing to acquire new, potentially very expensive land parcels.
So less dependency on new acquisitions.
Correct. Plus, they benefit significantly from policies like TOD, transit-oriented development, and TDR, transferable development rights.
Okay, maybe quickly explain TOD and TDR for us.
Sure. TOD basically encourages building more densely around transport hubs, like metro stations. Think mixed use, maximizing land value near transit.
Makes sense.
And TDR lets developers, effectively, sell the unused development potential from one plot to use on another. So if rules limit height on one site, you might sell those air rights to build higher elsewhere.
Okay, so these policies help them unlock more value from the land they already own.
Precisely. It means they can maximize the potential of their existing holdings, combine that low-cost land base with their focus on luxury and super luxury projects.
And you get high margin potential.
Exactly. It's a powerful combination for profitability.
Okay, that makes a lot of sense.
Yeah.
And their pipeline. The reports mention Some huge numbers for future projects.
Huge is right. I mean, just in Q1, they launched 4.7 million square feet, potential sales value, ours 11,000 crore.
On top of what they launched before.
Yeah, that adds to the 7.5 million square feet launched up to the end of FY25. But the medium-term plan is even bigger. They're looking at launching another 25 million square feet.
25 million. And the value?
Estimated sales potential there is Rs 62,900 crore. So you add it all up, their total planned launches, about 37 million square feet, could generate something like Rs 1,014,500 crore in sales.
Over 1 lakh crore rupees in potential sales?
Staggering.
It really is. And they also highlighted this figure, surplus cash potential from launched products.
Right, I saw that. Rs 46,500 crore as of June 30th. What exactly does that mean, especially the mention of REO 70% accounts?
Okay, so that surplus cash potential is basically the cash they expect to collect from projects already launched or underway. It includes net receivables and, crucially, cash sitting in those RERS 70% accounts.
And the REO accounts are?
Under the RER Act, the Real Estate Regulation Act, developers have to put 70% of the money they get from buyers into a separate account. That money can only be used for the construction and land costs of that specific project.
Ah, so it protects the buyers, ensures the project gets finished.
Exactly. So that RS 46,500 crore figure, it shows huge future cash flow visibility. It really underlines their financial stability, knowing that cash is earmarked and coming in. Okay, impressive growth, massive pipeline, strong cash visibility. But, experienced people always look for potential bumps in the road.
Always wise.
Which brings us to something important in the reports. The legal matters. These emphasis of matter paragraphs in the auditor's reviews, what are these about?
Right, the emphasis of matter. It's important to understand what this means. It's not the auditor saying the financials are wrong.
Okay, so what is it?
It's the auditor drawing attention to something already disclosed in the financial statements, but which they feel is fundamental to understanding the company's position. It's a flag saying, pay attention to this specific issue.
A flag. Got it. And we should be clear, we're just relaying what's in the reports here.
Absolutely. No endorsement, just reporting the disclosed information.
Okay.
So DLF is dealing with a few significant ongoing legal things. First, there's that Competition Commission of India, the CCI, penalty, Rs 630 crore.
What was that for?
It related to a complaint about alleged unfair conditions on buyers. An appellate tribunal upheld it, but DLF has appealed to the Supreme Court. They've deposited the money under protest, hoping for a refund. There's a similar case for a subsidiary, too, without a penalty, though.
Okay, CCI case pending at the Supreme Court. What else?
Second, a land issue in Gurugram. 2 ITSEZ or IT Park projects, about 56 acres. The Punjab and Haryana High Court actually canceled the land sale deeds and ordered structures removed.
Wow, that sounds serious.
It does, but DLF and its partners challenged it, and the Supreme Court has put a stay on the High Court's order. So it's on hold, pending the Supreme Court decision.
Okay, stayed for now. Next.
Third, some long-running issues with SEBI, the Securities and Exchange Board of India. This goes back to their IPO in 2007, related to alleged non-disclosure in the prospectus.
The red herring prospectus issue.
Right. An initial SEBI order restricting them was overturned by the Securities Appellate Tribunal, or SAT, but now SEBI has appealed that decision to the Supreme Court. There are also related penalty appeals that are sort of paused, waiting for the main Supreme Court case.
So another Supreme Court matter.
Yes. Fourth, there was a situation with a joint venture, 25 Downtown Reality Limited. The JV defaulted on debt, a lender sold shares, including DLF's stake.
Okay.
But this one seems to have resolved relatively well for DLF. Through a consent agreement and arbitration, DLF is actually set to receive Rs 801 crore. They've already got Rs 100 crore.
So they're getting money back.
Yeah.
More than they put in.
Well, their loan and investment was about Rs 658 crore, and they'd already made provisions for it. So getting 801 crore back is a positive outcome, financially speaking.
Right. Okay. Anything else major?
Lastly, there are some outstanding payments owed to a subsidiary, mainly from Coal India Limited CIL and some others. Totals over Rs 390 crore. These are mostly tariff disputes. In the CIL case, the Supreme Court has actually directed CIL to pay.
So they expect to recover that.
The subsidiary is confident based on legal advice and the court decision so far.
Okay, that's quite a rundown. So the takeaway on all these legal points, even if management is confident, it's complex.
It is. For a company of DLF's size and history in India, navigating this kind of legal and regulatory complexity is, well, almost part of the business environment.
Have to factor it in.
Right. Management clearly states they believe they have strong cases and haven't adjusted financials, but for you, the listener, it's a reminder that even with strong performance, there are these ongoing complexities. They require resources, attention, and they represent potential risks, even if management feels they're manageable. Worth keeping an eye on.
Understood. Okay, let's shift gears now, away from the development business and its complexities towards the steadier side, the annuity business, recurring rental income.
Right, DLF Cybercity Developers Limited, or DCCDL, their rental arm.
How did DCCDL do in Q1?
Pretty well. Consolidated revenue was Rs 1,739 crore. EBITDA grew a solid 14% year-on-year, hitting Rs 4,356 crore.
And profit?
Consolidated profit for DCCDL was Rs 593 crore. That's up 26% year-on-year. Very healthy growth.
And operationally? Occupancy rates.
Overall portfolio occupancy is running at a strong 94%. If you break it down, non-SEZ offices are almost full, 98%. Retail also at 98%. SEZ offices are a bit lower, 87%, which isn't unusual given some shifts in that space.
94% overall is very healthy. What does this stability mean for DLF overall?
It means they have this really consistent, predictable, growing income stream. It's the anchor, in a way. It perfectly complements the development business, which can be more cyclical.
Creates balance.
Exactly, a diversified enterprise. And they're still growing this side, too. They just commissioned another big office block in Chennai, about 1.1 million square feet, already 99% occupied.
Wow, 99% right off the bat.
Yeah. And other projects like Atrium Place in Gurugram and Midtown Plaza in Delhi are showing strong pre-leasing, 73% and 81% respectively.
So demand for the rental spaces is strong too.
Definitely. And financially, DCCDL looks solid. Net debt to EBITDA improved to 3.2 times. Net debt to gross asset value is low at 0.20. Good leverage management.
That stable income is clearly crucial. But something else catching my eye in the reports was the focus on sustainability. What are they doing there?
Yeah, they highlight this quite a bit. DLF seems genuinely committed here, setting a high standard. They've got LEED Platinum renewals for big names like Emporio.
LEED Platinum, that's top tier, right?
It is. They also got LEED Zero water renewals for 16 buildings at Cybercity, Gurugram. 16? That's huge for water conservation.
Zero water.
Impressive. And then True Platinum and LEED Zero Waste for a few more buildings, focusing on waste management. Plus, Wired Score Platinum for digital connectivity in several buildings. They even released their first dedicated sustainability report.
Okay, lots of certifications. But why should listeners, really care about LEED Platinum or Wired Score? What's the practical impact?
It's a great question. These aren't just green badges for PR. They translate into real value. For tenants, LED buildings mean lower energy bills, better air quality, healthier workspaces. Wired Score means top-notch digital infrastructure, which is non-negotiable now.
So it attracts and retains tenants.
Absolutely. Modern businesses, top talent, they increasingly demand these standards. For DLF, it means their assets are more desirable, command better rents, hold their value longer, and align with investor focus on ESG, environmental, social, governance factors. It's about future-proofing their portfolio.
Makes sense. It's becoming table stakes. Okay, let's pull back and look at the big picture, management's vision. What were the key messages from the top, especially from the chairman at the AGM?
Well, the chairman highlighted the strong full-year performance for FY24-25, the year ending March 2025. Net profit hit Rs 4,356 crore. That's about 60% growth year-on-year.
60% profit growth for the full year.
Yeah. And full-year new sales bookings were Rs 21,223 crore, up around 44%. Collections were strong, generating over Rs 5,300 crore in net cash surplus for the year.
Solid numbers all around. But beyond the numbers, how does DLF see its place in the Indian economy? What broader trends are they focused on?
The chairman spoke quite compellingly about India's economic resilience, calling it a global beacon of economic progress despite global headwinds.
Bullish on India.
Very much so. He pointed to drivers like Make in India, structural reforms, the young population, expanding middle class, rapid urbanization, rising incomes, growing aspirations, basically all the key macro tailwinds.
And DLF sees itself benefiting from all that.
Directly. They feel perfectly positioned to capitalize on these trends, and he strongly reiterated their commitment to core values: governance, transparency, compliance, safety, sustainability, quality, customer satisfaction.
The trust factor.
Exactly. He emphasized that these values have strengthened DLF Group's reputation as a trusted brand. So it's not just about financials. It's a strategic view rooted in national growth and maintaining trust through core principles.
So wrapping this deep dive up, what really stands out to you from all this? It's quite a mix, isn't it? Strong performance, but also those legal complexities alongside really ambitious plans.
It is a complex picture, but maybe here's a thought for you, the listener, to chew on. DLF consistently generates huge cash surpluses. They talk a lot about sustainability and these integrated ecosystems, building whole communities, not just buildings.
Right, live work play environment.
Exactly. And they emphasize customer centricity. So the provocative question is, given all that, how might this focus actually allow them to not just grow bigger, but to actively redefine what urban living looks like in India over the next decade? Could they set a new standard?
Redefining urban spaces.
Yeah.
That's definitely something to mull over, a fascinating possibility.
Something to keep an eye on as you follow the sector.
Absolutely. Keep asking those big questions, keep exploring. Thanks for joining us on this deep dive.
My pleasure.
We'll see you next time.